What was your take on his comments and also the fact that just yesterday we saw the CME Fed Watch tool where only 30% of traders saw a 50 basis point hike. Now, after Powell's testimony, now 70% of traders see a 50-point basis hike coming up.
Yeah, so it just confirms the fact, right, that every time inflation started to decline and show progress, that it's going to be a long road to 3%, let alone 2. And Powell was clearly articulating the fact that, now that inflation, the labor market has popped back up, economic growth has improved, the terminal rate's going to be higher, and they're going to be at that rate for far longer than most of the perma bull crowd or those that are clinging to an '09 to 2021 type market environment we're hoping for.
So we saw the big sell-off yesterday, the Dow falling more than 570 points. We also saw a sell-off on the NASDAQ and the S&P 500. Was that a sign that not even a 25 basis point hike was priced in? I mean, this reaction, I don't think Jay Powell or anyone else from the Fed's ever said the words pause or pivot out loud, but the market seemed to continue to bank on this idea that we were going to see one.
Yeah, we think a lot of that gets back to, remember, there's a tug of war right now going on between technical traders, particularly systematic trend followers, and fundamental investors. There are very few fundamental investors that are naive enough to think that 18 to 18.5 times forward earnings on the S&P is cheap. That being said, after markets have bounced and passed the 200-day moving average, you started to see a lot of CTA or trend following buying. And so effectively, as Powell reiterated that, hey, we're going to go to higher rates for longer, and we opened the door to a 50 basis point hike, the fundamental investors dwarfed any technical buying. And if we blow through the 200-day moving average, it's sort of look out below at this point, given the forward trajectory of the Fed.
All right, volatile market right now. What are you telling clients about their investments right now, and where are you looking to put some money to work?
Yeah, look, in the big picture, this is an environment to protect capital. Don't be a hero. Focus on strategies that can make, mid to high single digits with low volatility, alternative strategies like senior secured commercial real estate loans, multi-strategy solutions. But we know that alternatives, even though they're more democratized now, they're never going to be more than 10, 20, or 30% of a client's allocation. Okay. So within, broader markets, you got to look for medium to long-term trends that you can believe in and tolerate the volatility. So one of our core theses the last several years has been tied to natural resources and energy. Okay. In that, basically the energy and natural resource complex has gone through this secular stagnation period for fixed investment in order to make new production. Okay. And that's
let me just jump in for a second. Yeah. I know you got a couple of picks for us, and just on the graphic there, we listed BDC. So you have some picks in the BDC space. Give them to us real quick, and why are you so bullish on this space in particular?
Yeah, so that's another theme is cash flow is king, right? And in an environment where the Fed is hiking, one of the advantages of BDCs, which are basically providing average investors access to private credit markets, which is institutional strategy, is you have primarily floating rate exposures. Some of them trade at significant discounts to NAV, which boosts the yield. So if you had to have a 10 to 14% dividend yield, you can tolerate a lot of volatility. That yield should go up as the Fed continues to hike. Right. And even though credit quality will deteriorate a bit here, a soft landing is not the end of the world for credit quality. So cash flow is king tied to that theme, and that gives you a way to play the upside to the Fed with a very healthy level of cash flow.